All right. Is it time? I think it's time. Yes, it is. All right, cool. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representative agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and trading services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you can't afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. Fantastic. I feel good about having read that. All right. Mute people so I don't hear all your
You are now muted.
background stuff. There we go. Anyone have any early questions? Yes, I'm recording. Thank you, Jim. Jim is in charge of all recordings. And Jal says, tra-la-la-la-la. Very good. Okay. It's Christmas time. Not yet. I think legally you have to wait until after Thanksgiving, I think. All right, where are we? Oh, still going up. Look at this. We're really trying to make these new highs. It's very exciting. Freaking that. Look, $700 up for the day. That is so exciting on natural gas. I can't believe it. Slowly but surely clawing back. What a freaking nightmare that trade's become. I almost want to get out of it, but I still really think it's going to go to $3. And $3 is a lot of money. It's $100 per penny. So 74 pennies is $7,400 per contract. There you go. I have 14 contracts, and whatever that is, it's a big number. So that's what I'm looking for. Might be a little bit greedy, but you know, what the hell. Basically what we've been doing is we get these little dips in the morning, and we use those as a buying opportunity. Then we get a little, you don't have to make much. You just buy 4 extra contracts here. And see, if you buy 4 contracts and you're at 23-ish, or 24, let's say, and then you get a little ride up to 27, that's 3 times 6 is 12, so you make back $1,200. So basically, they've been doing this over and over and over again. Every morning it dips down, and then it comes up, and you make $1,200, $1,600 on 4 contracts, and that's that. But that adds up, day after day. Last week, I think we were down, I don't remember exactly, I think it was down $7,000, $8,000 last week, and we've made back half of it almost, just on these little dip buys. Still have the same base, but we keep lowering and lowering our average price. So now our break even is only $228. In fact, frankly, it's hit our break even a couple of times already. Just I'm looking for a lot more, so I haven't done anything about it. I mean, I should technically I should be scaling back out. I mean, if we get up to 228, I should be taking at least 4 off the table, really 7 off the table, cut to lighten it up so that next time I can get back in more. But I kind of want to have 14. I mean, I really want to make $100,000 on this play. So 14 up to $3 is right about my target $100,000 gain, and that'll be a nice Christmas, right? So I just want to have a nice Christmas. I want to be able to buy something for my kids. All right. So either it comes in and we make a lot of money and they get everything they want, or it doesn't come in and they get their favorite oatmeal for Christmas, whatever. One or the other. Where are we? So we were shorting at 17,750, but we didn't get, although it slowed down a little bit here, we got to pop back over, and now we're all the way at 850. Holy cow. The S&P also came up over 2,100. The Russell barely paused at 1185, where it failed yesterday, so there was no good signal to sell, and it's back up now. No good signal to short, sorry. And if we look at some of these other guys here, let's look at the NASDAQ. Everybody's over, though, so there's nothing to short. You can't short when everybody's over until you see signs of a slowdown. 47.11 here. The Nikkei's crushing it. Don't forget 19.2 is a great line to short the Nikkei also. The dollar has peaked out and come back down a little bit, and that's kind of helping everybody come back up. It's not much, but it's a quarter point, and a quarter point is basically how much higher we are than we were before. Gold, way down 115, getting tempting. Silver, 1522, getting tempting. Apple, nice move after earnings, 1122 is back. Netflix, drifting. Tesla, earnings tonight. Amazon, higher than we'd like it. Win, I can't believe Win is up. I see these Macau numbers. Every time they're down. They've been down like for 4 years in a row, basically, all the Macau numbers. And yet, it wasn't as down as badly as they thought it would be down, so they're happy. Look at gasoline, 145. When's the last time we've seen 145? That one snuck up on us. Wow, you talk about a big move. Gasoline is $400 per penny, and we were at 130. I don't know when this is, but whenever this was, 130, like last Thursday, I guess. Wait a second, Tuesday, Monday, Friday. Yeah, so last Thursday, which is the day we like to go long on gas, we were at 130. We had that massive move up. And since then, it's kind of drifted, but still 130 to 137 is, well, I'm sorry, not 137, to 145 is 15 times $400-something a penny. So you're looking at $6,000 that move on gasoline. That's huge. Oil also is getting very enthusiastic, and if we look at oil back to Thursday, we were at, Tuesday, Monday, Friday, Thursday. So Thursday in oil, we were at 45. Here's Wednesday. Oh, maybe I'm wrong about gasoline. We're down to 43. So 43 to 48, that's $5. That's $5,000 per contract on oil. So really booming. Like in the last week, oil and gasoline have been booming. Poor natural gas, not at all. It's just been dead. But if you think about it, though, energy traders are energy traders, so they perhaps have been putting their effort into oil and gasoline, and not much money's been left to flow into natural gas. So just have to wait our turn on the natural gas, I think. I really do think our time will come eventually. What else is going on? Oh, yeah, we got to look at our hedges. Very important, because up here, we're either going to have a nice breakout, which would be fine, or we're going to need some more hedges if we don't. So we have to think about that. And let me just check if there's any questions at the moment. Nobody has a question. Jim's on natural gas. All right. Good luck, man. Let's see. Oh, portfolios, right. Okay, so we have the 5% portfolio took a hit. When the heck did I look at that last? Didn't we just do this Monday, right? We looked at it. I think that was Monday. Might have been Friday. It was Friday. Hang on a second. Here it is. All right, so Friday at 2 o'clock in the afternoon, the option opportunity portfolio was at 18.3%. We have not touched anything. Yesterday we were at 19, and now we're at 16. I'm not sure which particular position is going wrong. I imagine SQQ has gotten damaged, but I guess you'd have to check that by seeing where we are. So SQQ is net. Oh, that's a lot. That's 8,000, and then add back 1,700, so 6,300. So we're down 6,300 there. And where were we here? Here, oh, see, here we were down a lot less. So that really is the difference. SQQ's gotten really bad on us. Now, so this is also, by the way, this is a good reason why we do our portfolio reviews on a regular basis, though, because when something does go wrong, we want to figure out what went wrong and can we take advantage of it. Okay, can we take advantage of the thing that went wrong, turn it in our favor? So, now we're going to look at each leg of the SQQ spread and figure out if there's a way we can improve this spread using the changes that have come in the last day. Now, here we have long calls and more long calls. Well, that's weird. Oh, I see. So this is basically a spread. Yeah, this is the January 17 longs. Oh, I see. These were these were dead. That's why. My mistake. These are the November 23s. These guys are basically dead. You know, so we don't care about them. They're just sort of sitting there as a placeholder. What we really have is the January 17 longs, January 23 short. So the question is, on the January 23s, have they lost enough money to make it worth us taking them off the table? So in other words, we're up $1.30 per contract on these. That's our gain, is $1.30 per contract. Is that enough for us to flip naked? And if we do, then what is our position? How are we going to feel about it? Well, don't forget the purpose of the SQQ is to lock in gains that we have in our long positions. The problem is, though, the long gains aren't really making up for the short, because we went aggressively short into the weekend, so we haven't seen that yet. Since it's January, let's think about this logically. Since it's January, and these are 23s, they're way out of the money already. Essentially, these things don't have a lot left to give us, okay? They're at 70 cents. So January is, it's going to be all of October, November, I'm sorry, all of November, October's gone. It's going to be all of November, December, January. And into the middle of January, then they expire. So in 3 months they expire, or less than 3 months they expire, and they're going to be 70 cents. So we're going to gain about 25 cents per month if we keep these guys. It's not really a logical sale, because I'm sure we could replace these with something in November that we get 25 cents for. So let's take a look. So see how that thought process is? In other words, all they're going to really give us, because they're completely out of the money, so all they're going to really give us is 25 cents a month. So what if I wanted to get 25 cents a month for something in November? Well, I could sell November 20 calls. Those were last sold for a quarter. All right, but those are a lot lower. We have the January 17 calls that are like $2. If we want to roll them, what we could do, though, see here, is we could buy back these 23s for, it's not even 70, it's like 68, 65. So we could buy these guys back for 65, sell the 18s for $1.65 or $1.60, let's say. So we get another $1 there. Then we could use that dollar to roll these 190 January 17s to the 15s. Is that worth it, though? That seems like a whole hassle. So I'm not really inclined to do that either, because it's not that exciting. Now let's look at April. We have $2, basically, or $1.90 in our January 17 calls. And what would we do? Well, that's January 2. Oh, no, that's June. Oh, wow, really? No, it's March. Okay. I knew there'd be something between there. So now March. So where could we go in March if we spend about $1? If we spend $1, we're not going anywhere. We're just going to go over the March 16s. It's about the same price. March 17s. The March 16s are $4. No, they're not. They're $3.25, $3.30 now. These guys to $3.80. Well, that's almost interesting. Should we spend $1.80 to go to the March 15s? No. We're only getting $2 in position, and we're buying some time, but I don't think that time's the real issue here. So we're paying a lot of money for $2 in position when we might still get burned even worse than we are now. So there's no point to that. So the real question in isolation then becomes, do we want to buy these guys back, the 23 short puts? If we buy them back, we increase the cost of our 17 calls. I'm sorry, 23 short calls. If we do that, we increase the cost of the 17 calls by 70 cents. I'm not really keen on that. Now, how much did we spend? We spent, it's kind of hard to do the math because it's all messy, but technically, we spent 17 minus the 23. So we spent about $2, but we also didn't fully cover. But we spent about $2. So if we add it back, they're currently worth $2. So we're not really at a loss right now if we leave it alone. If we do buy these back, we're then risking 70 cents. We're now creating essentially a loss that we don't currently have. So now the question becomes, how much do we feel, A, that we need the protection? That's question number one. B, that the S&P, that the NASDAQ is topping here. How much do we feel that way? Well, if we want to know how we feel about the NASDAQ, we got to look at Apple. So let's look at Apple and see what they've been up to. Oh, okay. So Apple is taking a little poke back over this 200-day moving average. This is today. I think it's today. They're coming back over the 200-day moving average. So they've got a pretty good shot at getting back to test 132. That's going to drive the NASDAQ. That's a lot because, here's my calculator. Oh, I thought I put it in this thing. Somebody told me this last week and I already forgot. Oh, no, I didn't. Oh, wait. Calendar. Mail, Cortana. All apps. Is that where we found it? There it is. Can I put you on the taskbar? Yeah, I can. There you go. All right. That's so ugly. Ugh, they should be ashamed. All right. What was I going to say? Oh, yeah. So we're at, let me just double check on Apple and see where we're actually at. Wow, Exxon's still flying higher. There's a thing in Libya. That's what's going on with the oil right now. But Libya is cutting production because of the war, with all the stuff going on over there. So that's rallying oil for sure. Doesn't affect natural gas because natural gas is a local thing. It's not something who cares what Libya is doing. What matters is oil. So it might cut like 1 million barrels a day off global production, which is, thrilling for people who want to be long on oil. Anyway, Apple 122.66. And if we assume it goes up to 132, that's $10, and $10 divided by $10 divided by 122 is 8%, and 8% times 0.15% of the NASDAQ is 1.2%. 1.2% times where the NASDAQ is now, which is 5148. Holy cow! Times 5148 is 63 more points. So if Apple goes up to 132 to retest that, then NASDAQ will go up about 63 more points. That'll put it at 5,200, almost right on the button. 5,200 on the NASDAQ is probably not a bad shorting spot, though. So now we're going to look at the NASDAQ. Oops. And see, last time we talked about 52.31 and had a hell of a dive back, right? So, being this is the second time is usually not a charm for breaking out over something. So, since this is the second time, we're coming off a similar bottom. This rally came off of about this level. We came back and tested it. We came back up. We go back up. We come back and test it. We go back. We come back and test it. We're going back. So, I think there's probably a good chance that we'll have a good pullback in the Qs. So that means even if Apple goes up, because Apple's going to hit a point where it's likely to turn back down. If Apple turns back down, it's going to drag the whole NASDAQ with it. And this can all happen this week. It will happen tomorrow, frankly. We're so close. In fact, today, the NASDAQ is up what? Like 95 points today. No, that's not the NASDAQ, sorry. NASDAQ's up 22 points today. The Dow's up 95. So on the whole, so then having weighed out all those different things, this is what I go through every time I try to make a decision, by the way. So if you guys ask me a question, it takes me this long, I'm making this many steps. It doesn't take me as long as I don't explain it while I'm doing it. But I'm going through all these steps before I say, oh, you know what, let's buy those back. So I'm officially going to say, yes, we are going to buy back. I'm going to make a note so I remember to do this stuff later officially. So you're going to buy back the 13 short, that's in the OOP, 13 by 13 SQQQ, whatever they are. January 23 calls. Jan 23 calls. All right, so, and that's for 65 cents at the moment. All right, so officially that's what we want to do. All right, what does that do? See, now, by the way, I'm sorry, there's one more reason that I lean towards it. So aside from the fact I don't really think we're going to gain much out of this, I'm sorry. See, some things I know which I don't bother saying because it's just in my head. The January 23 calls have a delta of, that's not a delta. Damn it. Oh, I hate this new setup. Layout. Is this where I can do it? Customize. Delta. Add it. Okay. There we are. See, I don't notice because it's like I know it in my head what the delta should be, so it's not like I really look at it. But the delta is only 23. That's why it didn't make sense when I saw 68, because I was like, that's too much. The delta is 23.24. So, if the NASDAQ goes up, I forget the number, we said, 1.5% or whatever. So if the NASDAQ goes up 1.5%, then this will go up 3%. 3% of 18 is 50 cents, and that'll make a 10-cent difference here. You follow? So if this rose 50 cents, it would be half of the delta would be, 11, 12, whatever the hell it is. So it'll be 12 cents is going to be the change in that particular option. So therefore, it doesn't matter, for the want of 12 cents, it doesn't matter whether we time this perfectly or not. So the point would be to say, let's just offer 65 cents. Don't offer 68. Don't offer 70. Let's offer 65. It should fill. If it doesn't fill, it doesn't matter. It's not a big deal. But if it does fill, I'm willing to take it off for 65 cents. And the best part about that, though, is then we're flexible. So if the NASDAQ does spike lower, and let's say there's a big drop of, let's take a look at SQQ and see what's realistic. Just going through all the steps that I go through when I'm talking about these things that I usually just do in my head. So if we look at what the SQQ's done recently, then you get an idea of what a realistic movement would be. So in any given day, it doesn't actually move very much. See, 1750, 20. Here's a big gap that we had on this day. But generally, SQQQ, other than a strange day like this, is really kind of just it's a grinder. Just kind of grinds up and it grinds down. So we're not going to miss much. And we're not likely to get a great big move. But it does have these potentials for a big gap here and a big gap there. And see, here's the difference. If something like this happened, this was the 24th when we had a Black Friday or Black whatever the hell day it was. On a day like this, when we have a really big downturn, if we're in a covered spread, we aren't going to be able to take advantage of that spike. And we can't take advantage of the spike because the short calls are become an obligation while the long calls make money. So by buying back the short calls, we are now in a much better position to take advantage of any kind of quick move up. And there are a good amount of quick moves up, like here and here and here. And here, very quick one-day moves that mostly reverse themselves. This one didn't. It's 3 days up. So if we do get a big spike and we make our 270 back, we can lighten up on that position if we want to. Although we probably won't because it is our hedge against our other positions going down. All right. So officially, short story, which honestly, if somebody asked me what should we do about the Qs, I would have said that it would take me about 15 seconds to answer that question. I think we probably spend about 10 minutes on it here. But that's the process I go through to make a decision like that. So there's that now taken care of. So we're going to buy that out. That leaves us flexible here. These guys are dead anyway. And on any spike up, or any move down in the Qs, which moves the SQQ up, our next move would be we want to again sell November calls. We'd love to sell more November calls because we have this stopper in November. We may as well make use of it while we can. And we have these January deep calls, so we don't mind that. So if we get a chance to sell some November calls for 50 cents that still give us a decent spread, we'll probably want to do that and pick up some more cash. But these we can get rid of now because there's no point in keeping those for 3 months. We can do better if there's an opportunity. We can jump in and make more money than that. Oh, also, by the way, having this naked, should the NASDAQ plow higher for some reason, even to 5,500 or whatever, like crazy move up, then the opportunity presents itself for us to sell some puts and do a roll. So we'll still have some way to salvage that. So I'm not worried about it. There's a lot of things you can do when you have an insurance play. Oh, and by the way, we've got 92,000 cash. And the reason for that is even though we're only technically up 16.3% on the positions, if you look at what we've actually closed, we've closed $20,000 worth of positive plays. So that's real. That's what matters. The day-to-day balance doesn't matter. What matters is you keep taking good winners off the table. Now, UNG, we keep repositioning. We've got a loss there so far. SQQ, interestingly, we're actually hugely up on SQQ because all the ones we've closed, except for that guy, have really been generally winners. So we've kept closing winners and taking them off the table. That's why we're left with crappy ones. On the whole, though, the entire position is basically revenue neutral, which is great because it's a hedge. That's what it's supposed to do. We finished off this SCO trade. We got out of it finally on 10/28, and we ended up getting whatever, not much. It wasn't exciting, and we only made a little bit of money on that in the end. We had our Netflixes for a while. We had our Robot, FXI. We still have a bit of that in trade. That one's completely closed. The Dow we're completely done with. That was a good trade. That was bullish. Oddly enough, we were bullish on the Dow at one point. We forgot all about that. Back in the day, back in 824, that's right. When the market tanked, we jumped in and bought bullish Dow plays. We made a nice chunk of money on those. CCJ, we gave up on them and never went where we wanted to. And Sotheby's, we're sitting on that big position waiting for earnings next week. That's going to be exciting. So that's that portfolio. Now let's take a look at the butterfly portfolio. Should be nice and boring. I don't even know where we were last week, but we're stuck around 90% right now with this gyrating market. And but that's normal because you don't usually do that well in the first couple of weeks because we sold January, November. It's it's a little early for the Novembers to start losing their value. We just have to wait for them to start petering out, and we'll make our money. We generally make our money closer to expiration day. You don't make a lot of money early in the cycle. But God, how can you not love this thing? We don't do anything. We just wait for the money to come in every month. Long-term portfolio is going to be loving this little market rally we're having. So 48.3% is right where I thought it should be. There's, that's a lot of positions. They're long-term. And look, 23 of them, there's not really a lot. 23 are puts. Okay, so we only will become positions if we get a cheap price on them. As it stands now, they're all actually doing pretty good. We have like $200,000 in these short puts. So if the market goes up and up and up, we make $200,000. That's not a bad strategy. We have one bull call spread. We have two of these, and here's 20 actual positions. These are the actual long-term positions. We only have 20 of those. All these are placeholders. All these short puts are placeholders. We're saying if AA is $13 minus 245, so if AA is $10.55 in January 2017, then we'll own it. If Anthem is 110 minus 6, so 104 to 137, then we'll own it. If HomeAway is 23 minus 2 is 21, then we'll own it. It's $31 now. All we're saying is if the thing goes on a 33% off sale, we'll buy it. If not, we'll keep this cash. How much cash? We collected $2,000. So that's what I mean by a lot of money drops in our pocket. $2,000 here, $3,000 here, $5,000 there, $7,500 here, $8,300 there. All this money drops to our bottom line, and it's already in the cash. But all this money, this negative $123,000 sitting out there, that drops to our bottom line from all these short puts that we sold, if the market stays up. If the market goes down, then we take some of our sideline cash and we put it into these positions, which are stocks we really like at those prices. It's not a complicated strategy. Then once we have a position, we work it like this. We sell puts, we sell calls, we do things, we collect our dividends, whatever it is. We're managing these positions for the long term, but we're always aiming towards giving ourselves better and better discounts on the way down. So we keep giving ourselves better and better deals. So currently we're up 48%. We're well on track to make another 20+% next year, as it already, just with the positions we have now. We don't have to do anything fancy. We just have to stick with where we are. So people ask me, like, if you start in a long-term portfolio now, what do you look at? When I do the reviews, I mention, like, this one's good for a new trade, that one's good for a new trade. Basically, you can see it, though. You can see that if we have a position like BHI that's negative, this one's negative $6,000, but this one blows my mind here. This BHI position is negative $6,000 according to the balance. That doesn't mean the balance is correct, though, because these balances can be wacky. But according to the balance we have here, this position is negative $6,000. Now, that would mean theoretically that you'd get a $6,000 credit. I'm sorry, you wouldn't. These are the totals. Wait. That's the market value. Okay. So the market value here is 21 minus 19, so that's what, 2, minus 4 is a $2,000 credit. So in theory, though, you get at these prices, not that I'm saying, not that you can definitely get those prices because the brokers give you the worst possible prices on spreads. But it looks like negative $2,000. Yet, if BHI closed at 53 today, then we have the 45 calls that would be worth $8. Okay, $8.65 to be exact. And we have the short 55 calls we'd have to give back like $1.50 on. So let's call it, this would be $8.50. So let's call it $7 times 20 is $14,000. So this one position here, which is currently showing negative $2,000, will be plus $14,000 if BHI gets bought out at $53.65. All right, so the minute the Halliburton deal closes, if it closes at $53.65, that turns a $2,000 loss into a $14,000 gain. And that's 3% on our portfolio. Now, I think it's still going to close somewhere closer to 65. We actually have 70. We make all the money up to 70 that this thing closes. But if you want to say what's a good position to get into, this was our runner-up to our trade of the year last year. Now, Apple trade we already took off the table. It did so good, but this is our runner-up to the trade of the year, and you can still get it right now. This company's being bought. At any minute, this thing can close out, and all this loss goes away, and it turns into a profit. Any second, tomorrow, they can announce the deal finalized. You don't have to wait until 2017 to make this money. So if you want to know how to make 5 times on your money real quickly, this is probably the best one. Now, it's possible the deal falls apart at the last minute and you're stuck with Baker Hughes shares, but what are we stuck with? We have a $2,000 credit, and we end up owning Baker Hughes at $55, where it is right now. But the breakup fee on the deal is $3.5 billion. So if the deal doesn't go through, you have Baker Hughes plus $3.5 billion, which is very nice. So that's the long-term portfolio anyway. So the only one we have left to look at is the short-term portfolio, and that, of course, is taking a hit. So we're going to have to make some adjustments here. Because if the long-term portfolio is doing well, the short-term portfolio should be doing badly, because that's the hedge. So we're 230% here, which is fine. I mean, being up 230% is not exactly a terrible thing, but it would be nice to be up 300%. So, and we were up well over 250 before, but because these are our hedges, we have some work to do. So we've got these SDS, and SDS is at 19, so we have to decide whether we want to sell calls against that. I'm not in a hurry, though, because I think everything's toppy. We have our Amazon short calls. Those are hurting us right now, but not so badly, so we're okay. That's actually one of our biggest losses, so I'm insuring a $39,000 loss. So if it wasn't for that, we'd be up 360%. 260%, sorry. We have the Buffalo Wild Wings shorts. They stopped going down. I think maybe we need to pull the plug on these because they're not. I thought they might make another leg down, but we're not seeing it. We don't need the money, but I mean, there's really no point if it's not going to go any further down. You see how they are? This is why I didn't pull the plug yet. They're here, and they're kind of consolidating for maybe a move lower. And that move lower is big money for us because we're already in the money or at the money. So we could pick up another, $5,000, $10,000 as this thing goes lower. So I'm kind of inclined to stick with it. Just let's give it a little bit longer. I know. It's not good. It's not smart, but it's good. Oh, GLL. Absolutely want to double down on these. All right, so STP. I'm making my notes. So double down on GLL. And that's not official because I'm not sure if we'll roll it and double down or do what. What else were we looking at that I was thinking of doing something with? Nothing. Okay, no. Tesla. This is just a leftover. We at some point had a $140 short put, and we're just waiting for it to expire in January. So we're just waiting to collect our last $200 on that one. Again, the SQQ dilemma, but we're much lower here. We already rolled these guys, and we are in March. We're at lower strikes, and we're happy with it. Gosh, does that mean maybe that's what we should do with our SQQs? Should we do that in the option opportunity portfolio? Should we match that trade? That's interesting. Let's say no for now. But that's going to be where we'll back out to if we have to. We have this April TZA spread. That's in good shape. Do I want to buy these back is now the question. 55 is miles out of the money. It's the same kind of problem as we have with the SQQs. We're only going to bleed this thing like 50 cents a month between now and January. So if suddenly TZA takes off, we won't be able to take advantage of it because of these stupid things. So yeah, we're going to buy those back. That's a definite. All right, so TZA, buy short Jan 55. Okay, so let's buy those back and get rid of them. Now, $1.60. Also, see, people do this all the time because if I say a price, everybody sticks to it like it's gold. It's like you try to get your best possible price. So those are the TZA January 55. Because again, you have to think to yourself, it's not an emergency. There's no crying need to do this. It's just we'd like to buy them back. So if I'd like to buy them back, I'm sure not paying $1.55 if they're listed at 160 here. At the most, 120, 160 is the spread. In fact, look at the spread on this one, 110, 160 for the 56s, and 120, 160 for the 54s. So this guy's getting no respect. So I would say if we could buy them back for 140, I hate to pay over. let's say 140. All right, so basically on these it's like 140, I think. If I could get for 140, I'd do it. But even when I say that, I'm still going to put in an offer for 130 first and see if that fills. And if that doesn't fill, then I'll try 140. I don't lead with my worst case. You know, I'm always trying to get a better price, and you never know if what's going to make this cheaper. What's going to make this option cheaper? What will make it cheaper is if the Russell goes up and TZA goes down, and this becomes less valuable. That's when you're going to get your fill. If it goes the other way, we won't get our fill, but who cares? Because we have the $40 calls, and we have $15 between them. So it's no big deal if we don't get the fill, and I only want to get the fill if I pay a good price. All right, let's see if we have any questions. Sure we do. All right. No, not much. What a quiet group. All right. Taser didn't like earnings here. Taser. I have not listened to the conference call yet, so I can't make a definitive statement. But my impression of their quarter is they are selling a lot of these new things with the body cameras and the service contracts. Every body camera comes. You can't. There's no point. The camera itself is useless if you don't have a service contract. So what they're doing is they're giving a overall 5-year contract price that includes the price of the camera, but they're self-financing it, so it's killing their earnings because they're not recognizing the sale of the camera immediately. So they're recognizing they have to buy the parts, they have to buy the cameras, put them together, or whatever they're doing. They have to buy the stuff, and they have to deliver it to the cops, and then they have to wait until you cross, the same way like a phone company with their phones. They have to wait until the monthly fees cross the event horizon before they start recognizing revenues on them. So that's the problem. They are selling a boatload of cameras and contracts, but they haven't really. They just have to get over this hump of the model where initially they haven't paid for the equipment costs yet. After that, it's all gravy. After that, they're essentially selling. You know what they are? They're a cloud service provider, right? Because they're selling specialty cameras to the police that are constantly recording, and they're storing all that information digitally in the cloud. So they're basically selling cloud services to police departments to store their video feeds. So they sell them the camera equipment, then they sell the service on the back end that stores all the feeds. That's what Taser does now. They don't get the respect that the cloud service company gets. If the cloud service company was losing money providing services like that, they'd go, oh, that's brilliant. Right? Like Amazon or something like that. They go, oh, you guys are geniuses. That's exactly how to run your business. But because it's Taser and you're used to them selling a gun and making money on each gun they sell, it's the change in the business model makes it look bad. All right, so that's where Taser is right now. Still very good opportunity at this price. Igor Ethertel says, how can you short November calls in Microsoft? Wait, how can the short November calls in Microsoft be turned to an advantage? I don't know which ones you mean. Do you mean in the Butterfly? It's the only ones I remember having. Butterfly. Butterfly, Microsoft, November. We don't have any November calls. Damn. All right. You got to be more specific than that because that's, I have no clue what you're talking about. Oil. Do you think the barrel rollovers this month will offset the Libya issue and push oil lower? I'm not sure. It depends on how serious the Libya issue is. Somebody wrote a good article today. I forgot who it was, but I read an article about it was a good article that said exactly what I keep saying, except somebody more important than me said it. They were talking about the fact that what's not being recognized here is that the demand has been destroyed and it's not coming back. This is what people don't realize about oil. They think that any minute now everyone's going to start using oil again, but that's not happening. And it's not happening because every time you buy a car, that car gets better mileage than the car you had before. And the reason that Obama changed the standards years ago, like second year into his presidency, changed the standards, but we had a crash and cars weren't rolling over. Nobody was buying a new car for years. We had like a 3-year gap where people almost basically didn't sell new cars. So the whole fleet aged, but all these cars still have the same crappy mileage. In the last 3 years, though, there's been a dramatic increase in the turnover of cars. And the fleet that we have, the fleet of autos in total, had an average mileage of about 20 miles per gallon. The new standards, the standards that are demanded in the new fleet are 35 miles per gallon. So the act of trading in any old car for a new car immediately cuts about 30-40% off your mileage, even if you drive the same amount of miles. So if you figure that the average car in America is 10 years old, which is crazy that it is, but it used to be 7, but it's 10. And if you figure, though, even if you look at 10 years, that means 10% of our fleet every year, which is the #1 user of oil in the country. So 10% of our auto fleet every year is being rolled over and using 30% less gas. So let's say we use 9 million barrels a day of gasoline. We're essentially saving 1 million barrels a day each year until we change over our whole fleet. You know, we're going to save like, say 500,000, let's be a little less. So when you look at that in the grand scheme of things, and it's not just us though, because of the same cars are being marketed in Europe. Now, Europe already had higher mileage standards than we did, but it makes a difference in Europe. The same cars are being sold in China. You know, the car companies, once they're forced by a big country like us to start making high mileage cars, they say, well, we're not going to make special low mileage cars for other countries. We're just going to keep making these cars everywhere. So all around the world now, slowly but surely, this thing is spreading. And as far as I remember, we use roughly, I would say 15 million, 16 million barrels a day of oil, and probably 9 million of that is gasoline. In fact, let's take a look at the exact numbers. I don't want to give incorrect information. Petroleum status report. Here you go. Okay. So on the petroleum status report, we'll take a look and see what the actual number is. So here you go. Oh, actually, it's a lot. We're using 19 million barrels a day of product. You know, well, you can say we're not using it because there's a bill, but it doesn't matter. I mean, realistically. So we're using about 19 million barrels a day of product, 9 million of which is gas. Okay, so gasoline, and that's not diesel, by the way, because motor gasoline, diesel is distillate, so it's not our trucks. So the cars use 9 million barrels a day. That's what's going into cars. So 9 million barrels a day in a fleet getting 20 miles per gallon, all right, is going to be, well, compared to a fleet getting 35 miles per gallon, is going to be, let me see, 35, so if it's 100, that's 5 gallons, and if it's 35, it's 3 gallons. So that is 40% less. So let me take 40% times 90 is 1836. So 3.6. So over time, as this progresses in the next 7 years, basically, so almost by the end of this decade, we're going to be using 3.6 million less gallons of gasoline per day. That's a lot. That's so you have to put Libya into context there. And again, it's not just the U.S., though. It's basically a worldwide thing. So if we're using 19 out of 85, we're using about 25% of the world's thing. So if we're saving 3.5 million barrels, then that means the rest of the world's saving about 4 times that. So let's say that the total is going to be 14 million barrels a day, which is almost 20% of all the oil that's produced. We're going to save that in gasoline consumption over the next decade, and that means every year we're going to take an entire 1 million barrels offline that we don't need anymore, at least. So that's where we are. That's what it means by the demand destruction. Then you also have in other products and other energy sources, there's more efficient heating systems, more efficient lighting systems, all kinds of things that in one way or another everybody's saving a little here and saving a little here. So there's another it doesn't even have to be a lot because we're already at 14 million. But you're talking about, probably enough to get us to a point where we're saving practically 2 million barrels a day off of worldwide production. And it's not coming back. Not only is it not coming back, but if we make a breakthrough in electric cars, it could accelerate. So all these guys betting on long-term oil and thinking it's going to come back and stay up or whatever, they're wrong. I mean, you probably can't cut production fast enough to keep up with how fast demand is going to go down. And we're not producing enough people to make up the difference. And the other thing is that oil is no longer the cheapest form of energy. Solar and wind are now basically neck and neck with oil. So even if you look at the countries and say, oh, well, but India is industrializing and Africa is industrializing, they're industrializing, but they're not industrializing with oil. Why? Why would they? Given the choice from scratch over going with oil, which has an unsteady supply and is subject to all sorts of trends and so on and so forth, versus in Africa, just throw a bunch of solar panels out in a field and you can run your factory. The solar wins. So things are changing, and they're changing really fast. And that's the long-term thing about oil, that people are really missing it. And other people are starting to see that. I've been saying it for years. Other people are starting to catch on to this concept that oil is a declining product. And essentially, it's declining so rapidly in demand, you don't see it. It's slow grind, but the rapidly, as in 10 years, is nothing. And oil demand is falling off so quickly that we're just going to have this constant oversupply. And yeah, there'll be people who get out of the oil business, but they've got to get out of it at a really fast clip to keep up with the 25% decrease in demand that we're going to see over the next 10 years. That means the producers every year have to cut 2-3 million barrels a day's worth of production just to keep up with the declining demand. And not only that, though, but we're having tremendous. Look at this last year. Last year we had 1.8 billion barrels of oil or petroleum in the U.S., right? This is just us. 1.8. Now we have 1999.9. So we're up 175 million barrels in 52 weeks. All right, so now we go to Mr. Calculator and we say, well, if we're gaining 175 divided by 52, 3.3 million barrels a week. That's how much oil is being added, how much excess petroleum is being produced in the United States. And that's even though we're exporting 2 million barrels a day of petroleum products out of the country. That's a day, not a week. So we're shipping 14 million barrels of refined product out of the country to sell somewhere else because we got too much here. We have way, way too much here. And we're still getting a 3.3 million barrel build. That is the definition of too much oil. It's way too much oil. So there's going to be always a default to constant downward pressure. And, Libya can have a war, and this guy can do this, and this guy can do that. But unless they can knock off 2 or 3 million barrels worth of production, it's always going to be a short-term fix for them. It's not going to last. And that's why we were saying earlier today, we were talking in chat, and I said, look, if oil goes to 50, I'm going to go back to shorting. It's at 48.07 at the moment, just barely almost hit 48.50. 48.50 is kind of the zone where we might want to short, but definitely 50. So 48.50, I think I'd have a tiny amount of. I don't mind shorting at 48.50. So we're at 48.30 here. So right about here is where you can start poking short, but at 50, I'm going to have some conviction to my short. Here, I'd keep a tight stop, but as it goes higher, I'd have certainly more conviction about the trade. So meanwhile, where are we? We're only at 20. Wait, is that 21.04? That's not very exciting. I thought we were doing better than that. 17.855, 47.15, 11.71. What happened to the poor Russell? I thought it was Oh, no, that's not right. I'm like, how could that be? This bar, if you don't slide these bars on Thinkorswim, you have no idea what's going on. Okay, there we are. 1190 it finally stopped. 1192. Oh, and by the way, don't forget these lines. So the Dow's over their resistance line, right? They're over the resistance 1. But nobody else is. Everybody else has stopped at their resistance line. But you know what? When people pause at their resistance line, that's not really a good reason to short them. Like, of course they're going to pause at the resistance line. The Dow paused, punched through, tested it, and went back up. So on the whole, the Dow is now leading us higher, mostly because of Exxon and Chevron, which are on fire. And we'll have to see how that turns out. But and again, Exxon and Chevron are up because oil's up 4% today. They're very excited. If oil starts coming back down, they're going to be a lot less excited, and they're going to come back down. So that's actually kind of a fun short. I actually might like shorting Exxon here. Let's see how that looks. Yeah. Yeah, a big move up. They punched through this 200-day moving average. This is on earnings. This is on there. They had their earnings report, and it wasn't as bad on Friday. It wasn't as bad as people thought. And a lot of this is driving the Dow rally. You have them and Chevron both punching up to big numbers. It's not warranted though. It's going to probably 90. I would say is a good place to short. I'm not sure if I feel good about shorting at 87.50. How about Chevron? And these are both big Dow components. Chevron's a lot further from their high than the Dow is. So I'd be less inclined to jump on them short. Probably about here. See this 110 line? So maybe about that 110 line I'd like to get short on them. But I feel better about shorting Exxon because this 90 line, that's a pretty good line for Exxon. So, and they're close to it. So it's an easier short to short Exxon here than it's to short Chevron. Let me just double check where Exxon is exactly. 87.23. And then meanwhile, though, the interesting thing is, how does this chart get detached? That's weird. What did I do to cause that? Anyway, what was I saying? The Dow, right, okay. So Exxon and Chevron being Dow components and having a hugely strong couple of days, they are dragging the other components higher. So then we look at the other components and say, well, who's stupidly high now? Well, IBM making a nice comeback. We're long on IBM. That's our trade of the year, by the way, for 2016. So we're happy about that. Boeing is always a good one, but that's okay. Apple, certainly not overpriced. American Express, they're iffy. Caterpillar, pretty low. I like Caterpillar long here. Cisco I like. Chevron's the one we questioned already. DuPont, I wouldn't want to short them. Goldman Sachs, oh, that's interesting. Okay. GE might be a little high. Disney, not a bad price. Home Depot, that's iffy too at that price. They've got that, they're trying to do that merger that might get held up. IBM, I said we like them here. Intel, fair price. Johnson & Johnson, diapers in China is a good story for them, so we're not going to do that. JP Morgan, Coca-Cola, I like them here. McDonald's, they had a nice run from their disaster. 3M, I'm not sure where they are actually. Merck, okay. Microsoft, we know they're good. Nike, they had great earnings. Pfizer, Procter & Gamble, can't short that. Travelers can't short them. United Health, interesting, but tricky to short. UTX, having big trouble at 100. We'll see. Take a look at them. Visa, Visa's so dangerous to short, unfortunately. Verizon, Walmart coming back from the dead, and Exxon. Nope. So apparently still, we can take a look at, not too keen on UNH, UTX, and McDonald's might have gotten ahead of themselves in Goldman Sachs. So let's take a look now. UTX. See, the point is saying the Dow had a rally. Who in the Dow got ahead of themselves? Not UTX. They're still way down in the channel. Maybe Goldman. That's tricky. No, I'm unfortunately not going to have a good candidate here, I don't think. Home Depot and McDonald's. It's the only other two. And Home Depot, you come into hurricane season, stuff is short, but they are getting pricey. And how good of a recovery? Oh, look at McDonald's! Holy crap! I did not realize they came back that much. That's getting tempting. I'd say that's overdone. So there you go. So probably McDonald's is a good short. They had their earnings already, though, didn't they? Let me check that. Yeah, they already had their earnings. They are going to make, they're guiding for 485 for the year. So 5, they're in the 20s for PE. That's a bit much. Next year, really no growth. 525 next year. So they're talking about 10% growth. I mean, it's not terrible, but there's nothing to be excited about. They are almost good for a butterfly play at this point. Frankly, I'd start off with a short position, though. So I'd say probably you want to sell like some shorter term calls because I don't see them getting over 115. So basically, if you look ahead at McDonald's, this is how we come up with trades. So let me go to McDonald's because we think the whole Dow is too high, and the Dow within the Dow, McDonald's is way too high. We look at a good thing to sell at the January $115 calls. They're $2, and then we say, well, what do we want to protect that with? And say, do we want to protect it? And we say, yeah, just in case. So long term, and here's what you do. So we're basically setting up a future butterfly play, but we're starting off with a short call. So we start off by saying, well, we'll take the 110. Those are $8, $8.60, $8.70. Take the 110, 125 spread. Oh, they don't have 2018. That's a shame. But we could take the 110, 125 spread, $15 spread. That's going to be about $5, a little bit more than $5, $5.50. And then we're going to sell the January 115s for $2. So what does that do? That puts us in this long spread at net 550 minus 2 is 8, at net 350. So then you've got the long spread at 350. And once January's expired, then you've got plenty of time to sell. If you can sell $2 a quarter against that 350 spread, you're going to get $8 back on your 350 by the end of the year. So that by itself is a nice little position. So probably that's how I'd play it. And then when McDonald's got lower, when it gets back to 100, if it does get back to 100, then I'd be interested in selling puts and establishing that end of the spread also. So it's like a butterfly that you would work into over time, but at the moment it's not like in a place where I'd really want to jump in and play it. That's where you're over McDonald's. And as I say, Goldman Sachs is a bit dangerous. But that's how we look for plays. And very true to form though, 9 out of 10, not 9 out of 10, probably 19 out of 20 times I look at a trade, I'm going to end up saying, well, it's okay, but no. But when you find them, then you find them and you stick them in the portfolio. That's the way it works. All right, let's see. Oil, rollovers, Libya, right, we talked about that. Should we buy back TZA 55 calls? No, because 55 is miles out of the money. There's no point to buy. All you're doing is giving him money for no reason. TZA. So in other words, the Russell would have to drop off significantly. It's 55 is like the high of the high. So it's really not worth spending the money. It's so far out and so unlikely that it's not worth doing. Wait a second. There's something we bought back, though. Oh, damn it. I'm thinking of the TZAs in the short-term portfolio. They're different. There's a different story. No, I'm sorry. The TZAs that were in the option opportunity portfolio, they were bought back. We put them in for a nickel, and we filled them last week. We waited a long time to get the fill, but we did get it filled last week. So the answer is yes, we did do those, and they triggered for a nickel. So that was worth getting them off the table in that case. I'm sorry, I was thinking of the ones from the short-term portfolio that were leaving. Can you review your thesis long on UNG? Well, the thesis long on UNG has 3 parts. Part number 1, it gets cold in the winter, and people use more natural gas. That's part number 1. Part number 2, the price of natural gas has gotten to the point where shale production is shutting down. You can already see from the drilling rig count that there's very little drilling being done, so no new wells. And obviously, at some point, the production goes downhill, and they start doing it, and the drawer comes out of inventory. That's 2. And number 3 is there are several companies, including LNG, Cheniere Energy, who are starting natural gas export terminals. They're coming online actually now, like one's coming online like this month or next month, and another couple are coming on next year. Those terminals are going to export, it doesn't sound like much, but they're each going to export 1 to 2 billion cubic feet per day of natural gas. So if you have 2, 3, let's say you're only exporting 3 billion cubic feet a day out of 3 terminals, the minimum. 3 billion cubic feet a day of natural gas is 100 billion cubic feet a month. Our entire reserve is 4 trillion cubic feet. So that means you're going to be shipping 1.2 trillion, 30% of our reserves are getting shipped out of the country over the course of next year. This has never happened before. Now, obviously, 4 trillion, we don't need 4 trillion. It's a huge amount. So what we're doing is saying, look, we're a country that has a gigantic surplus of a resource that we have no real need for. That's why our natural gas reserves are always stuffed. And logically, if we can draw off our reserves for a long enough period of time, then there will be companies who will step up their production knowing that there are buyers, because in the United States, though, we're full. We physically can't store any more gas than we already have. So that dynamic will change. So for a little while, there'll be a run-up in the price of natural gas as we begin exporting it, but then new supply will come on, and once we run out of people to export it to, it'll slam back down again. But for the meanwhile, we're just trying to catch this little wave up that's going to come over the next 6 months probably. So for 6 months to a year, prices should have pressure upwards, and then they'll come back down. Because there's just too much. There's other countries that are also building terminals planning on shipping their extra gas to us. Because countries that have natural gas tend to have a lot more than they need, and they all export it to other countries that don't have natural gas. But these LNG terminals, basically the plan is everybody with extra gas is going to sell to everybody else. But they're already selling gas to everybody. And they're already selling gas locally to everybody else where you can get pipelines. They just haven't done it overseas. But once the ships start crossing each other on the ocean, what's the point? It becomes silly. So that's where we are with UNG. Also, by the way, filling these natural gas terminals, natural gas compresses 600 to 1 in a terminal. So for storage purposes. So when they start filling up these storage facilities, that by itself is going to create a huge draw in natural gas because we're just shoving it into the ground and compressing it. So that's going to create a very large draw also. So as these terminals come online next year, and there's 2 years of them coming online, but as they come online, especially next year, because it's the first time it's ever happened, there'll be a big improvement in demand of natural gas. Artificial, always keep that in mind, but it'll still drive the prices higher. But the other difference is because we're going to have so much gas stored in these terminals, if there's a hurricane that shuts down production, then all the terminal has to do is turn on the pipe and shoot the gas back where it came from, and all of our gas shortages are solved. So we'll also have the benefit of steadying out the overall supply of natural gas, so we won't be completely determined on whatever the Gulf put out last week is going to the pipes tomorrow. So now we're suddenly changing natural gas to a much bigger storage facility where we're not likely to run out of it. So various dynamics there. So we're going to take out the big spikes up, but we're also going to create this constant pressure up for a while until we until we reach an equilibrium with the amount of natural gas terminals that exist. Craig says, if oil demand is declining that rapidly, shouldn't we cut our losses on the rig trade, or are they somehow going to find a way to be okay? Well, again, it goes back to there will be still drilling. We're still going to be taking oil out of the ground. There's no incentive at all for American producers to cut back. We still import a lot of oil. We don't import much from OPEC, but we import 19 million barrels of oil. We import about 8 million of them. So there's no reason that U.S. producers would want to cut back. It's cheaper if somebody drills if somebody drills in the ocean in the Gulf, and they have a pipe that goes from there to Louisiana. That's a lot cheaper than somebody who's drilling oil in Nigeria and putting it on a boat that comes over here in 3 weeks. Okay, it's cheaper oil, bottom line. So the drilling will come back, and that also will reach an equilibrium. And also, I do think it's too cheap right now. Oil is too cheap at 45. Just because it's going to go lower, just because it should go lower this winter, doesn't mean it's not too cheap. 55 is essentially the global correct price. In a non-war global situation, 55 is about the right price for oil. So we're still too cheap right now by quite a bit. So that, and again, that's another reason rig will come back eventually. And rig and BHI the same thing. They're drilling. It's not like we're going to stop drilling for oil. We're not. You're acting like it's tomorrow. We're talking about over the next 10 years, we're going to knock 25% of our demand of oil down. But even if we did that tomorrow, it still means that we import more oil than we use in America, than we produce in America. So it doesn't change, and it doesn't change the dynamics. This is over 10 years this is happening. It's soon, but from a trading perspective, it's not that soon. From a trading perspective, oil can go up to 100 still the next year or so on some silly spike for whatever reason, some war, shortage, whatever, There's all just because something long-term has a trend doesn't mean short-term it'll obey that trend. Here, in fact, as an example, let's take a look at the price of GoPro, which was a stupid idea when they IPO'd, and it's been a stupid idea ever since. Yet that doesn't stop them from going up and down and up and down and up and down and up and down, then up and then down, then up and now down. They were never worth more than this, ever. But that doesn't mean it doesn't go up to double, triple that amount, back down, 50% down, almost double, and then cut back in half. What do you think changed the value of this company? Nothing. It's all perception. Nothing to do with actual value. And natural gas is the same thing. If you look at natural gas, because natural gas is not a war issue. We're completely supplying our own natural gas, but that doesn't stop it from going from 3 to 6. Back to 3, up to 450, down to 250, up to 3, back down to 2, and hopefully back to 3. We're just betting on the stupidity of the whole thing. Whether you believe the correct price is 250 or 2, or you believe the correct price is 350, the bottom line is it's still going to gyrate like crazy in between those prices. So generally, you just want to be a buyer when it's low and a seller when it's high. And do that over and over and over again until you make some money. We're into time. Wow, 2:15 already. Draghi used the market 20 minutes ago. Oh, did he? Oh, man. What did he do? So annoying. Really disgusting, because Draghi, ECB, still missing 19 hours ago. That's not it. News. 9 hours. Euro weakening ahead of Draghi again. Draghi cast doubt on stimulus. That doesn't sound like it. Draghi speech ahead. Draghi speech preview 1 hour ago. Well, Draghi, we'll meet our price. Here we go. Inflation should be neither too high or too low. Oh, God. Asset purchases are proceeding smoothly, continue, blah, blah, blah. Governing council is willing to act. Here you go. He loves saying this, using all the instruments available within its mandate. That's really not saying anything. It sounds like you're saying something, but it doesn't mean much. The pace of monetary will need to be re-examined in the December meeting. That's also bullshit. That means nothing. He's concerned about the growth prospects for emerging markets. I'm not sure how Europe is going to save them, though. Sees downside risks for growth and inflation. That's a strong statement. Okay, so when you say we see downside risks to growth and inflation, first of all, what the hell are we so happy about if Europe sees a downside risk to growth and inflation? So Europe is saying we see recession and inflation in our future, and a person in America goes, oh my God, let's buy stocks. That makes no sense. And it's up to individual countries to build foundations set by the policymakers and make their economies work better. That's a negative statement. So I don't really see this as being anything good or bad. It's just the same nonsense he's always spouting now. I don't know why people even pay attention to this guy anymore. And what's actually happened, so that's what pushed us back up. It makes me more inclined to short, frankly. Oh, yeah, look at that. See, very, very tempting. Can't pull the trigger if everything's going up. Like I said, see, that's what I said about the Dow before. Because the Dow had punched over, and these guys were only paused at their lines. So it doesn't make a good time to short. I wish it did, but it does not. But anyway, I think this is again, it goes back to the same thing. It's a great time for us to take a stand. Certainly on the Nikkei at 19.2, I'm going to get very interested in taking a short there overnight. Because they've had nothing but bad news generally in their actual markets. And what we're doing, oh yeah, we're doing questions, right. So thanks, Rob. That was Terex Tex is making a nice run. Yeah, they're a good company. How would you adjust your play last week? The November 108, 110 spread. What are we talking about? I'm sorry, I don't know what that is. Anyway, so tell me what it is and we can do it. Like U.S. troops putting in, yeah. There's so much stuff going on in the middle. I mean, look, it's oil is always though based on geopolitical tensions, but so is gold theoretically, and gold's been doing terribly. In fact, there's Steve saying very timely, gold is getting down to 1,100 support. Would you be a buyer? Absolutely. We already added some gold somewhere, didn't we? I think we added gold in the short-term portfolio last week. Just a spread to get started. Because the bottom line is, it looks like we want to be in a position, so we take a spread, and then we, hang on, let me see if I can find that. Maybe that was an official trade. So, you start out with a spread that's a minor commitment, and if you hit it, you hit it, and if you don't hit it, then you roll back and start making a bigger commitment out of the thing. So far, obviously, we wouldn't have hit it. Here you go. So this was when? This was the 30th. That's Friday, right? So here we are. Oh. There it is. So on the 30th, looking at gold, which was coming, that's obviously not the 30th, but even coming down to 1140. Everything else was rising. The dollar was down 1%. Yet gold, now the dollar's up, so it's different. But at the time, gold was going down. I mean, the dollar was going down, but gold wasn't moving. And now the dollar shot right back up. But look, gold is like miles below. It's at 114 here. So we looked at the November one. Oh, is that the one you were talking about, the November one? Now I see this trade. That worked out. Because he said GLD. Okay, so that's where we are. So now we're all caught up. So what's the GLD spread? So yeah, in the short-term portfolio, which I'm not sure is reflected in that one, but in the short-term portfolio, we have this trade. The November 108.50, 110.50 bull call spread with gold at 109.75. I'm not sure where gold is now. Is it 107? Is that? Oh yeah. So now it's at 107. Whatever. There's a fair price of 110 potential 21. If gold can go up 1%, let's do 50 of those in the STP. Okay, so the November 108.50s, we paid 95 cents for that spread. So you now look at the November 108.50s. We don't care about the short ones at all. So we go GLD. And look at the November 108.50s. And they're now actually below the 95 cents that we wanted to be in. So we do want to do something. This is the thing, when the call in your spread goes below the price of the net of the spread, that's when you do want to make a roll decision. And what do? You take advantage of it because, okay, so we're going to recover 65 plus out of 95 cents that we paid for the spread. We're going to take this 65 cents and we're going to roll to a position that got much cheaper. So we're going to skip December and we'll look at January and say, what can we do with January and put some more money into a position that's buying us time and buying us position? Can we get down to the 106s? That's expensive. That's going to cost us a lot of money. So that might be too much. But we're also going to be anticipating selling something. So let's say we sell the 110s for 150 or 155, I guess. We sell the 110s for 155. We've got 65 cents on the other guy, so that's 155 plus 65 is 170, 230. So now we know we have 230 in our pocket. So what can we do? Now let's add $1 to 230, and we can pick up the 106s. And then we're in the 106, 110 spread. So we sold the 110s. We have the 65 from the original, from the calls that we have. We sell the 110s. That gives us $2.30 because we sell these guys for 155. Then we're going to add $1 out of our pocket, and we're going to be in the 106s. So now, what did we do? We originally spent 95 cents. We're taking another $1 out of our pocket, so now we spent 195 to be in the 106, 110 spread. So originally we spent 95 cents to be in the 108.50, 110.50 spread. So we're going to make the same 100% if it goes well. Now we spent 195 to be in the 106, 110 spread. So now our long was 110.50. So now our long is now this point at which we get a successful exit. And that's how you manage a trade like that. So I would say yes, officially that's going to be the trade. So GLD in the STP, we're going to roll the long 108.50 calls, November, and we're going to roll them down to the January 106 calls, and we're going to sell the January $110 calls. And that will leave us with the short November 110.50 calls. Nope, not 110. Sorry. Yeah, was it 108.50, 110.50? Yes, it was. That's going to leave us with these short calls, which are 27 cents. I would put a stop on them at 40 cents just to be safe. It's almost tempting to just buy them back for that price. In fact, you know what? I would buy back half. So that would be my move. I'd buy back half, put a stop on the other half at 40 cents. Because then worst case scenario, if you buy back half for 26 cents, then you've obviously, you've only spent 13 cents per long more, right? Because you bought back half for 26 cents. So you spent 13 cents per long position, more money. And now you have an easily manageable half a short position to deal with. And even if you end up paying 40 cents for those, you're only going to add 20 cents more per long, and you will have spent 33 cents per long. But the only reason you would have spent it is because gold went up higher, and now you're doing well on your long position. So that's logical. So it's really, so in other words, setting up, there's no way it's going to really hurt you, and the only sacrifice you're making to put yourself in a safer position is 13 more cents on your longs, which isn't really worth worrying about when it's not even 10% of the position. So again, that's the kind of logic you want to use when you're thinking about how to adjust your positions and what to do with them. All right, so that's how we're going to play that gold play. So we're still going to have the same, it's still a good aggressive spread. And, you know, and we're going to actually, see now the interesting thing about this is because we're actually putting more money into it, we will make twice as much money if it goes well. Because before we could only make $2, get back $2. Now we're going to get back $4, although we've doubled our input to it also. So basically we've doubled down on the position, but we set ourselves up to double the win. And that's how we get a little bit more aggressive about it. Now, that also takes into account that if gold does go down to 1,000, we're going to be happy to roll to June or even 2017, even lower GLDs, because long term we really think gold's going to be over 1,000. So even if it does drop another $10 on GLD to us, we're going to be even more enthusiastic playing it, the same way we were in August when we went gung-ho long on GLD. So it's not going to bother us if it goes lower, but we certainly want to keep selling calls. We're not going to be greedy. We'll sell the calls, then we'll roll, we'll sell more calls, we'll roll and sell more calls. But eventually, if it goes low enough, we'll stop selling calls and we'll just say, hey, you know what, at this price, we'll just go long. Which is kind of what we did with silver at one point last year, and that worked out fantastically. And it's where we are in natural gas now, in fact. Natural gas has gotten to the point where we said, screw this, we're not covering, we're just going long. That's what our position in natural gas is like. Not that it's helping because it's under 225 again, but in theory, that's what we're trying to do. All right, so that's all taken care of, and we're right on time, so I think I should probably wrap this thing up. Look at that, 2:30. I'm a genius. All right. All right, we have actually done a successful webinar that actually ran at the time it's supposed to run. An hour and a half is the max we're supposed to do. So thank you, everybody, for coming. I answered all the questions. I'm thrilled with that. And I'll try to write up these positions that we discussed, and I'll have a note over to the option opportunity people and, of course, for all the Stockwell people. And we'll follow up again on this next week, all right? So thanks a lot, everybody. Have a good day.